Hello, and thank you for joining us for today's Advanced Practice Center webinar with John Snider from John Hancock. John is the AVP of the Advanced Market Group for John Hancock, and he provides life insurance, tax, estate planning, business planning, and charitable planning expertise for his home office, as well as the field force and producers. For joining John Hancock, John worked for a law firm in Kansas City and actually also graduated from the University of Kansas. John has over 30 years of experience, and he has served many insurance professionals in the advanced markets. And we're so grateful to have him as part of the advisory council for the APC, or the Advanced Practice Center. So I'm sure most of you are here because, if you haven't heard about it, we've got a lot of inflation and a lot of things to talk about in macroeconomics. So John is going to lead us in a great conversation today. A few housekeeping notes. Please put yourself on mute and also put your questions in the question and answer at the very bottom of your screen. We will answer those at the end of John's webinar. So John, I'll leave it to you.
Thank you, Carla, very much. And thank you all for joining today. This is an extremely challenging environment for clients. Clients are concerned about a multitude of risks that they're facing and the stability of their own retirement. We're going to talk today about several macroeconomic factors that place downward pressure on equity markets and discuss how life insurance product selection and structure can help clients address these concerns in this environment. So let's take a look at some of the macroeconomic factors. Each one of the factors on this slide and the following slide does place downward pressure on equity markets. And you really can't open the news app on your phone or turn on a news program without seeing a number of these issues raised. Of course, inflation is on everyone's mind, and the Bureau of Labor Statistics reported that inflation is now at a 40-year high. That is, the consumer price index for all urban consumers increased 7.9% over the last 12 months for the year ending at the end of last month, February 2022. This is the largest 12-month inflation increase since the period ending January of 1982. So this is an environment that many clients are not very familiar with or comfortable with. As part of inflation measurements, the energy index rose 25.6% during that time period. And also for this last year, the index for gasoline rose over 38% over those last 12 months. So, with that, the Federal Reserve met yesterday, as you know, and the Federal Reserve raised interest rates by 25 basis points and really set the table for 6 more interest rate increases this year. The Fed is also reducing its balance sheet, which further tightens the money supply. Those actions will certainly increase interest rates further. And when interest rates rise, that's going to depress stock prices generally. Borrowing becomes more expensive for consumers, so they have less discretionary income to spend on other things. That cuts into corporate profitability, and borrowing for corporations when they want to expand or handle other business investment, when they have to borrow at higher rates, that also cuts into their profitability and puts downward pressure on stock prices. With regard to deficit spending, where we are as a country is we have more than $30 trillion in national debt, and that doesn't include Social Security and Medicare promises for future years. And of course, we're spending a lot on an ongoing basis. Just yesterday, President Biden announced some additional relief going to support efforts in Ukraine. So, with all of this, we have the potential for future income tax rate increases. And of course, what would that do to markets? Well, once again, if income taxes on individuals increase, they have less discretionary income to spend in the markets, cutting into profitability of businesses. And if income tax rates on businesses directly increase, that has the same impact in terms of reducing profitability, which decreases share prices. And of course, we're really at a crossroads in terms of geopolitical instability and risk with the situation in Ukraine. Secretary Treasury Yellen recently commented that the war in Ukraine is exacerbating inflation and that there's a tremendous amount of uncertainty related to what's going on in Russia and Ukraine. Markets, of course, don't like uncertainty. So let's look at some other factors that consumers are grappling with right now. With regard to the pandemic, China just saw a surge in Omicron infections and has shut down. They've issued some shutdowns in major cities. That's going to directly impact China's equivalent of Silicon Valley. And so we might see some additional supply side shortages out of that situation there. Of course, we don't know what might happen economically if another variant comes out, perhaps a strain that vaccines aren't effective for yet, or if there's a strain that causes even worse hardship than the world has already experienced. So that type of uncertainty causes a lot of stress worldwide. We also have slowing fiscal stimulus. A lot of the pandemic stimulus that's been pushed out in the United States over the last 2 years, we're at the end of those programs. And so those dollars were helping bolster the funds that were in consumers' pockets to spend. We don't expect that level of stimulus to continue going forward. There is domestic political division and unrest to deal with as well. Repeatedly as a country, we run into our debt ceiling limits. And unfortunately, some of our politicians are willing to use debt ceiling votes to try to get political gain with respect to their other objectives. That is an extremely dangerous game for politicians to be playing. It would be, in Treasury Secretary Yellen's words, catastrophic if the United States defaulted on our debt. We are only able to borrow as a country at such favorable rates because the rest of the world has faith in our creditworthiness, and we could see a significant downgrade in the quality of US debt. We could also see a tremendous negative impact in the equity markets if we were to fail to raise our debt ceiling and actually default on our debt. Next, we've seen, particularly over the last few years, unusual weather patterns: heat waves, droughts, wildfires, hurricanes, tornadoes, and flooding. Those types of things, in addition to the human loss, cost a great deal of money and cause additional supply chain disruptions, which once again puts downward pressure on equity markets. So we saw through 2021 equity markets doing very, very well, actually. The S&P 500 hit record highs more than 50 times last year, causing some analysts to say that our equity markets are overvalued and that we might see a significant correction or worse. We also tend to see historically investors chasing markets. And we certainly saw that through 2021 with those repeated market highs, investors moving out of safer alternatives that weren't yielding much at all, getting into the equity markets. And now, of course, The S&P 500 is down, when I checked just a little bit ago, about 8.5% year to date, even after yesterday and today's rebound type performance. So all of these factors suggest that clients could have significant headwinds with regard to the performance of their equity portfolios going forward. So what can we do from a life insurance perspective in terms of, can products be used to help address some of this market risk? So first of all, we want to think through product selection, and there are several choices. First, clients may be very comforted by the downside protection built into IUL products. For example, if the markets drop by 10%, 15, or 20%, instead of the client having that type of down year with an IUL product, they might be looking at a zero in terms of how that product operates, shielding them from the significant negative market performance in that example. So using an IUL product to give a client some significant upside market potential while limiting their downside potential is one favorable strategy for professionals to consider in this market environment. Other strategies to consider include heavily funding VUL or IUL contracts. The additional cash put into the contract can serve as a cushion or buffer to allow that product to better withstand market fluctuations. And when we're talking about a VUL contract, for example, you may want to look at the death benefit guarantee on that contract, because you do have significant downside exposure with a VUL contract if you're invested in anything other than the fixed account. And in those types of situations, the client again can get some relief from risk and peace of mind if that particular contract has a death benefit guarantee, for example, to age 100 or lifetime. Next, some clients in these markets want to take some portion of the assets on their balance sheet and move them out of the equity markets. And there's certainly a place for current assumption universal life products here as well. For example, one current assumption universal life product, which is John Hancock's Protection UL product, we recently increased our crediting rate on that product to 4.65%. And so that crediting rate increase applies not only to new policy purchasers, but to existing Protection UL policy holders. That's certainly just one example. You should check with the carriers that you work with to see what types of crediting rates they're offering on their current assumption UL products. The point is, some clients will want to use a heavily funded current assumption UL product so that they're not subject to the same market fluctuations that a VUL or an IUL would be, but they're still planning to receive that currently favorable crediting rate on the product. Next, using a long-term care rider or a chronic illness rider, and also taking a look at critical illness riders when applicable. That type of rider added to a policy, those types of riders, can give clients additional protection from the types of risks covered by the riders. So all of these things help give clients greater financial stability and security through these types of choppy equity markets. And in the process, you can also address diversification issues. And tax diversification is certainly something that clients and their advisory teams should be thinking about going forward. As we've discussed, given the country's need for revenue and our national debt, as well as looking at where tax rates have been historically, Many clients and their advisory teams believe that tax rates will be going up in the future. And so using the tax-favored nature of life insurance to accumulate cash values and then access those cash values on a tax-favored basis can be extremely beneficial. There's also the opportunity for financial diversification inside of different product types. For example, looking at the sub-account selection in a VUL or an IUL product. We still see perhaps too many clients who are over-concentrated in a single stock or single business, and that financial diversification can be an important component of their overall long-term strategy. And of course, with life insurance, death benefit is certainly right at the core of what the product is providing. And so it gives the client a direct opportunity to address mortality risk, and with an appropriate rider, such as a long-term care rider, address morbidity risk at the same time. When we look at a LIMRA chart of where sales have been for different types of products over time, one of the things that's interesting to note is that if you focus on the time period from 2010 going forward, you can see that as interest rates continued to decline during that time period, fixed universal life product sales declined while indexed universal life sales increased during that time period. I would expect going forward to see a couple of things happen. One is, I believe there will continue to be a high interest in indexed universal life products because of that downside market protection in these market conditions. I believe we'll still see strong variable sales, particularly when looking at a product with an extended death benefit guarantee. And depending on where the markets go, more and more clients might be spooked by what's happening in the markets and might come back to a current assumption universal life product, particularly as carriers increase their crediting rates on those products relative to what other financial institutions are offering in the marketplace. So while we're looking at what's best for the client and what the client's objectives are, keep in mind that this inflationary environment is an environment that most clients aren't very familiar with or comfortable with. And so they may not have thought through the impact or potential impact of inflation on the death benefit that they're purchasing. So what we've done for you here is use a simple calculator. This one is in Number Cruncher. And we've taken $1 million and looked at what amount would be required to yield the same purchasing power, for example, 20 or 30 years out, if we look at 2%, 3%, or 4% as an assumed inflation rate. So since the inflation rate is closer to 8%, let's focus on future value, column number 3, the 4% rate. If a client wants to leave a child $1 million in death benefit in today's dollars, if that $1 million, if we had a 4% inflation rate, you would need nearly $2.2 million in death benefit to give the child the same purchasing power in year 20. And you would need a little over 3.2 million in death benefit to give the child the same purchasing power if death occurred in year 30. So what should we be thinking about as clients are telling us how much death benefit they want? First of all, we need to understand whether that's in today's dollars and how much the client wants or needs in the future. Next, we need to look at what are some of our product options for addressing that inflation concern. Some of those options include a return of premium rider. And keep in mind that at many carriers, you have options to select what percentage of the premium will be returned along with the underlying death benefit. So a return of premium rider can allow the client to receive the base death benefit plus a return of the amount of premium selected. There's also an increasing death benefit option, sometimes referred to as an option 2 selection on a contract, where the policyholder is going to get the base face amount plus the cash value in the contract. And in my opinion, in this particular environment, we really should see a lot more option 2 death benefits selected, particularly when those contracts are heavily funded with cash. That can give the client something that moves along with inflation, depending on what sub-accounts are chosen in that contract. Certainly can give the client a way to increase that death benefit over time. Another option, if the product allows it or if the carrier offers a rider for it, is to schedule from the very beginning an increasing death benefit. So a supplemental face amount that is underwritten for at the very beginning, it's scheduled, it becomes part of the contract. And that scheduled increase in death benefit can simulate a particular inflation rate, for example, 3 or 4%. Next, because of how the testing in 7702 works, clients can also take a level death benefit contract and put enough cash value in it that, particularly in later years, the corridor testing under 7702 can force the death benefit up because we have to keep a particular ratio of cash value to death benefit under those tests. Now, that doesn't increase the death benefit from day one, but in some client situations, they may be focused on a particular later set of years where they would like to see that increase in the death benefit. So those are all options for how to help a client get an increased death benefit in a later year in response to their inflation concerns and needs. While we're talking about inflation, let's talk about what happened to the per diem amount in 2022. Many of your clients might not be familiar with this, but it may have a dramatic impact on them. And it certainly is food for thought when we consider what types of products clients might have the most interest in going forward. So the per diem amount was $400 per day in 2021. And so, that was an amount that would be permissible as a tax-free payment under a per diem driven rider in 2021. And that per diem amount dropped to $390 in 2022. And this was really a shocking development, because when we think about where we are from an inflation perspective, why would the per diem amount, so these amounts typically are used to offset long-term care expenses, why would the per diem amount drop in this inflationary environment? The answer to that has to do with a provision in the 2017 Tax Act. In that act, the per diem amount indexing changed from a regular CPI index to a chained CPI index. And with a chained index, the inflation indexes are not as dramatic because with a chained CPI, what the economists are assuming is if the cost of beef goes up, clients are not going to eat as much beef. They might eat more chicken. So you get a slower assumed rate of inflation with a chained CPI index. Well, when we plug in that chained CPI to the per diem formulas in the tax code, the formula amount for the per diem amount in 2022 is actually all the way down at $270 per day. Now, the Secretary of the Treasury has the statutory authority to set the per diem at a higher amount. And in fact, they did. The Secretary set it at $390 per day, but that was still $10 a day less than last year. So where does this leave clients? Well, over time, because of the change to the change CPI, the per diem amount has really been overinflated. And we really don't know what the Secretary of the Treasury is going to do with the per diem amount in future years. This is in 2022, this is the first time that the per diem amount has declined. Why would the Secretary of the Treasury do that? Well, Secretary Yellen is very, very aware of how much debt the country has. It's very, very expensive to continue to increase the per diem amount. That gives clients who are dependent on a product or rider that bases its benefits on the per diem, that gives that client very little comfort going forward. And so from a product selection standpoint, it's important for advisors to help clients understand, is your long-term care or chronic illness rider or product, are the benefits tied to the per diem amount? And if so, how are they tied? It is possible to get a qualified long-term care rider or product that is not tied to the per diem amount. In fact, the benefits are tied to the actual long-term care expenses incurred by the client. So it's very important for financial advisors to help their clients understand what type of product the client has so that they can look at what the future benefit streams might be. As a planner, the planning community may want to think very hard about product selection in that environment. For example, selecting a product which is not tied to the per diem amount allows clients to choose how much long-term care protection they're actually purchasing, rather than simply being dependent on the Secretary of the Treasury to set some future rate. After all, there really isn't any way to predict what the Secretary of the Treasury will do 5 years, 10 years, 20 years from now. And so how can a client plan for those future benefits? And that planning is very important because clients need to know that they're purchasing enough benefit to cover their needs. And clients, given the choice, oftentimes will prefer greater predictability. So, just one more point on this, and that is when clients compare the drop in the per diem amount with some of the inflation figures that they see in the news. For example, on this slide, you see a reference to Medicare Part B premiums increasing by 14.5% in 2022. Those clients will be shocked to find out that the per diem amount has actually dropped. The clients likely to be most impacted by this are clients who are already on claim or will go on claim in the future, having products that are driven by the per diem amount. So with that, let's take a look at a strategy that at John Hancock we refer to as the retirement income backstop. This is an extremely important planning opportunity, I believe, in this environment, because clients don't know exactly which risk is going to impact them in future years. But by carefully designing a product and funding strategy, we can effectively give clients a solution that allows them to address a variety of risks, whichever ones they might happen to face in their situation going forward. So, the first thing in this analysis is helping a client understand how prepared is the client for their own retirement? How much have they saved? What do their spending habits look like? And what do they project in the future, considering some of those factors that we've spoken about, such as inflation and market performance? How are their retirement assets invested? and how might that look for them with different scenarios in the future. And of course, as always in planning strategies, the client's objectives are paramount. We certainly want to be delivering solutions that are a direct response to the client's objectives, moving them from where they are right now to where the client has told us they want to go. And we know that clients are very concerned with the possibility of outliving their retirement assets. So let's take a closer look at some of the risks that might cause a client to outlive their retirement assets. Any of these things can derail an otherwise very well prepared retirement plan for a client. The client might have health issues, including long-term care needs. They may simply outlive their retirement assets and live longer than planned. They may have unexpected expenses that we refer to as withdrawal risk. And we're going to talk more about sequence of return risk as well. That's something that most clients haven't thought about, but certainly given the performance of the markets for the first part of 2022, it's something that with an explanation, they'll be much better able to grasp, and I think they'll respond well to opportunities to plan to minimize sequence of return risk. And we've already mentioned taxes and inflation. So let's go through the concept in a little greater detail. The retirement backstop concept involves the client using a permanent life insurance contract, typically funded for reasonable to heavy cash accumulation, depending on the particular needs. And the client, first of all, is going to benefit from the death benefit protection. And so in typical life insurance fashion, one of the risks that's being mitigated here is mortality risk. That is, the death benefit can provide for the client's spouse, the client's other family members or other beneficiaries, covering necessary expenses at death. And of course, depending on the situation, they may have estate taxes to consider or other significant debts or expenses, as well as their desire to provide a legacy for the beneficiaries of their choice. So putting the death benefit in place is foundational to the retirement backstop. It's really the first part of the backstop. But the backstop, similar to a backstop on a baseball diamond, can also stop a number of other pitches coming at it. And those pitches are the different risks that we've talked about. So let's take a closer look. Let's focus for a moment on longevity risk, and then we'll talk about how a product choice or funding method can be used to address that. With longevity risk, clients oftentimes, when they look at an illustration or a projection, will focus on life expectancy. And we all know that life expectancy is just an average number of years that a person is expected to live, and that 50% of that population in that life expectancy study is expected to live beyond life expectancy. And so it's much better for clients to not just focus on life expectancy, but focus on lifespan, that is the potential number of years that they may live. What are their plans for funding their own retirement throughout that potential lifespan? And have they prepared for that? Certainly, using a heavily funded permanent product, so there's significant cash accumulation in the product, can help a client with longevity risk. So think about a very cash-heavy policy design. For example, funding a policy just under the modified endowment contract limits. But rather than starting distributions at, say, age 65 or even 70, in a retirement backstop scenario, one of the options that the client has is focusing on what will the cash in that product be at age 80 or age 85, for example. So if I'm the client and my retirement plan is focused on, will my retirement assets get me to life expectancy? And I'll just use age 85 as an example here. Wouldn't it be nice as a client to have another asset that has heavy cash accumulations, where that cash can be accessed on a tax favored basis to take the client from age 85 throughout the rest of their life? And the retirement backstop gives the client an opportunity to do that. Now, the client certainly has options of which asset types to tap during their retirement and then from age 85 to 100. But that gives you an example of the intent and the flexibility of the retirement backstop. So let's take a look next at the long-term care impact on finances. So as you all know, long-term care can be extremely expensive, with the client in some cases paying more than $100,000 per year to cover their long-term care expenses. And those expenses are expected to rise with inflation relatively rapidly. So by some estimates, more than tripling in the next 30 years. Those types of expenses can very quickly derail an otherwise solid retirement plan. So a life insurance contract with a long-term care rider or chronic illness rider, where the death benefit can be accelerated to meet those long-term care needs and provide another pool of funds to do that, so that the client doesn't have to tap their retirement accounts alone to cover those expenses. The long-term care rider can be extremely helpful in preventing the client from decimating their other retirement accounts to cover those long-term care expenses. Next, let's go to the sequence of return risk. And this is one that I think it's very important for clients to understand, given the market volatility we've experienced year to date in 2022. And so with sequence of return risk, what we're focusing on is, unlike a life insurance illustration where we typically have a set rate of return that we're looking at over time, set assumed rate of return. In the markets, of course, we get returns that go up and down. And so with sequence of return risk, what's happening to the client is they're experiencing perhaps a negative rate of return late in the accumulation years or early in the withdrawal years once they've started their retirement. And the client may not ever recover from even one significant market downturn. So let's take a look at that. The timing or the sequence of the returns make a massive difference in what's happening. So here we have Mr. Smith and Mrs. Jones. Both of them retire at age 65 with a $2 million retirement account balance. And each one is going to withdraw $100,000 a year each year in retirement. However, they start their retirement in different years. So what you're seeing on the slide is, and this is really the only thing that's different in the returns on the two slides, the first 2 years and the last 2 years for the client who retired later. So we see Mr. Smith retiring in 1969, and in that year, the assumed actual return was a negative 15%, a little more than that in terms of market downturn. The fact that the client essentially sold equities at a market downturn, Mr. Smith will never recover from. In fact, at age 86, he runs out of money in this example. Mrs. Jones, keep in mind, she's withdrawing the same $100,000 per year. She didn't experience that negative 15.19% return. She retires in 1971, and look at the chart in terms of how she does. Out at age 95, she has more than 2.3, almost $2.4 million. That is an unbelievable difference in terms of how these calculations mathematically worked. And the only difference between the two calculations is sequence of rate of return. So, with that, let's take a look at how cash value life insurance can help. First of all, having a life insurance contract with significant cash values in it, typically funded underneath the modified endowment contract limits, can provide the client with a significant source of income. And by that, I mean tax favored withdrawals or loans from the contract. So for example, what if the client who experienced the negative 15% rate of return, what if he had an IUL contract that in that year, the rate of return was 0 because of the downside protection in the IUL chassis? What if the client would have taken the $100,000 on a tax favored basis out of the IUL contract, or considering the tax advantages of that wealth versus the ordinary income coming out of his 401k or traditional IRA? What if he would have taken less out of the IUL contract? In that situation, how his retirement looked illustratively there would be dramatically different. So you can see how we could take the favorable product feature, give the client an option so they can decide which bucket of wealth they want to draw from in a particular market condition, and in that way manage the sequence of return risk. Another product choice that a client might think about using in a situation like this is the client may want to take a portion of their balance sheet and put it into a product with a more stable rate of return inside that contract. For example, either a current assumption UL contract or a fixed account within a variable chassis or an IUL chassis. Being able to draw from that fixed account rather than selling off securities that may have dropped 10%, 15%, 20% is going to make a dramatic difference in how that client recovers from sequence of return risk. Next, there is the withdrawal rate risk, whether that is, in this example, paying for an unexpected home repair or a dream vacation or an unplanned for medical expense. Having an additional asset in the cash value in that life insurance can help a client, again, have another source of wealth to fund those types of unexpected withdrawals. And the client can choose, based on the tax nature of different buckets of assets, which bucket should I be drawing from at a particular point in time. Now, we've talked a lot about inflation and how inflation erodes purchasing power over time. If you recall the slide where we projected out how much more death benefit a client would need to leave $1 million to a beneficiary in today's purchasing power. And medical expenses, most planners that I speak with tend to forecast that medical expenses will rise perhaps much more significantly than the core consumer price index. And so with that, having the long-term care rider is very important on the long-term care cost side of things, but also picking a product that gives some upside market potential, like an indexed UL contract or a variable UL contract, can also give the client an asset that has the potential to move upward with the market, providing some natural hedge against the ravages of inflation. Of course, the planning team needs to look at that client's overall portfolio and determine how the life insurance should be designed, how it fits into the client's overall strategy. Next, with respect to taxation, we can see when we look at top marginal income tax rates that we're at a relatively low level right now historically. How long do clients think that that can continue? in this particular environment when we have such a high national debt? Well, most clients, I believe, think that income tax rates will increase in the future. And so with that in mind, it's all the more important for clients and their advisory teams to think through the tax consequences of taking wealth from different types of assets, whether that's a 401k or traditional IRA coming out as ordinary income, whether it is mutual funds, stocks, and such that are throwing off dividend income, and perhaps capital gains. You can see in the middle portion of this slide, 3 basic buckets for taxation coming out of different balance sheet items. Life insurance, of course, is in the tax advantaged area. And so the retirement backstop solution is helping a client provide more tax favored assets so that they have greater choices in later years in terms of the tax consequence of the bucket of wealth that they're drawing from. So you can see that with this retirement backstop solution, the death benefit, of course, is extremely important. This is life insurance. And by choosing a product and funding it at an appropriate level, we can also help the client mitigate some of the macroeconomic risks that we've spoken about today. And for example, with a long-term care rider, that product can also help the client provide for the potential to offset long-term care expenses in the future. So, with that, what we really want to do is understand the client's concerns, understand the client's situation, and then look very carefully at the product choices that different carriers are offering. And we want to look at the planning strategy that we're using, such as the retirement backstop strategy, design a strategy, help the client pick a policy, and look carefully at rider availability as well. All of those things, including the funding design of the policy, can be critical components in helping a client meet their long-term objectives. And of course, going forward, helping the client manage that policy in an appropriate manner. So with that, why don't we turn to questions?
John, so my intro should have been welcome to the smartest man, because that was amazing. Some of the comments have been so great about how much information there is here. So thank you for that. First question, how would you set the policy ownership when structuring a contract for income in the future, but keeping the death benefit out of the insured's taxable estate, and in parentheses, state estate tax issue?
Okay, so here we have a situation where, and we can really broaden the question to either federal or state. It sounds like, if I'm understanding the question correctly, this client wants a state tax exclusion, but they want access to policy values. If that client is married, one of the first things a planning team is going to think about is a spousal lifetime access trust, where one spouse creates an irrevocable trust for the benefit of the other. That grantor spouse funds the trust with separate property, particularly important in a community property state, that the beneficiary spouse not contribute anything to the trust. And then the access is in the hands of the spouse who is the beneficiary of the trust. And of course, some planners will look at each spouse creating a spousal lifetime access trust for the benefit of the other. But when they do that, it's very important for the supervising attorney to consider the reciprocal trust doctrine, create enough differences in those trusts that the IRS won't unwind or uncross those trusts. Now, if the client isn't married, this is a much more difficult planning exercise, because under code sections 2036 through 2038 of the Internal Revenue Code, you can't retain access to an asset and still have it excluded from your estate for federal estate tax purposes. So what I've seen some planners do is the grantor of the trust, let's assume the grantor is not married, creates a trust for the benefit of children. The grantor retains no direct or indirect rights to benefits from the trust, but the trustee might choose, for example, to make loans back to the grantor in a future year. Again, very important that there's not strings or pre-understandings about how that's going to go because of retained interest concerns.
John, there's a question in the chat about your answer here. Could you use split dollar to?
Yes, and thank you to the questioner for that. You can absolutely, and let's look at loan regime split dollar first, which is really private financing. The client could make a loan to the irrevocable trust, of course, at an applicable federal rate or higher. Now the client has the ability to receive back the principal on that loan plus the interest on the loan. And that receivable or note in that case is going to be included in the client's estate, but that would give the ability for the trust to pay back the client directly, and properly drafted, the rest of the death benefit is outside of the client's estate. So that would be one way to use a split dollar technique. Another technique would be economic benefit regime split dollar, which would work in a somewhat similar fashion, although the recovery right is different in that situation.
Okay, here's another one. Do LTC per diem issues apply to fixed daily benefit standalone LTC policies?
Yeah, what you're going to want to do is look at the particular contract itself and look at, is the contract paying out a benefit that's either limited to or based on the per diem amount? You can have a contract that's a standalone contract that pays out a per diem amount designed for use with long-term care. So it really is important to look at the specific contract, contact your carrier, and ask them specifically, is my benefit tied to the per diem? And if so, how?
Amazing. Great. And one last question. Let's talk about when you're dealing with your clients that you have now, and what if you only had the chance to talk to them about one of the multiple things that you've brought up, which do you think is the most, not necessarily important, but the most impactful, say, or the best way to start the conversation?
Actually, the first thing that I would suggest doing is listening to the client. Far too many times, individuals in a sales capacity will rush to tell a client all the great news that we have for them, all the things that we can do for them. Clients are moved to action when we hear them, we understand them, we listen to their concerns, and only after fully understanding their situation and their goals, then we offer a creative solution. By asking clients the right questions, when they answer those questions, they're really designing their own plan. So by the time we present to them, here is something that I believe will help you, we already know it's exactly what they want because that's what they were describing as they answered our questions. So, and unfortunately, I'm not sure that I can point to a particular item today that would be, the best thing to lead with. But I always start by trying to listen first.
That was actually the perfect answer. John, thank you so much for today, for all of your work at the Advanced Planning Center. Thank you to the Society and NAIFA for coming together to put this webinar on, and the series of webinars that you will be seeing throughout the year, plus 3 live events. And thank you everyone for joining us. If you did not come away with a snippet to go talk to clients or questions to ask your clients about, then I'm not quite sure what to say. But we want to thank you for being here, and thank you to John, and thank you to John Hancock for allowing you to speak to us today.
Thank you very much. It was a pleasure to be with you.
Thanks, everyone.